Romain, why don't we ask the experts to answer that question? Let's bring in Kathryn Rooney Vera, head of global macro and chief investment strategist at Bulltake Capital Markets, joining us from Miami. And Kathryn, when do you start to see some of this supply chain shortages, even the labor shortages that's showing up in the data? When does it start to show up within a concern of the equity markets?
Yeah, we're already seeing it showing up in the data. This morning, we saw manufacturing come in below consensus expectations, and that's precisely because of these shortages, not only in microchips, but also in raw materials, not only in basic industrial products, but in human capital as well. And my suspicion, Taylor, is that it may not flow into the equity market pricing. You know, it's something that's temporary in nature, and the Fed is right on that front. There are some inflation impulses which are temporary in nature, and these are a few of them. I think that the combination of higher wages and improvements on the health aspect with the increasing vaccinations and lower case count is going to pull people off the sidelines and enter the labor market. That shortage, both in labor and materials, I think, as I said, is temporary in nature. What is not temporary, Taylor, is the combination, as Romain said, of this V-shaped recovery, which is truly, it's truly remarkable how the economy has ricocheted. And on top of that, we're continuing with both fiscal and monetary stimuli, which is the main driver of equity pricing. So my suspicion is that equities are going to continue to move higher. It's volatile. It's not a straight line, but I remain bullish for this year.
And you see that, though, today where you have industrials, right, materials, sort of that classic risk on tone really filtering through some of the big leaders. Are you all in on that value, that recovery trade?
So I'm recommending a barbell strategy, which means stay with the Fed play and the federal government play, which is both buying, of course, of $120 billion in assets per month, and then on the government side, spend without thinking twice about it. And I think that's where we need to be. Long equities, and I would add to that green energy stocks, which are going to receive just basically a fire hose of spending over the next few years, and add to that perhaps emerging markets, banks, and consumer discretionary, which we saw take a little bit of a dip today. And then on the more defensive side, which I think we aggressively have to mirror the inflationary risks in each portfolio. And this is something I've been talking about with my clients for more than 6 months, Taylor. The addition of tips have flown, you know, it's more and more of a consensus trade now, but staples, healthcare, puts, gold, even cryptos, tips, alternatives, and real estate, these are industries and sectors and asset classes that outperform in an inflationary environment. As I said, some of it is short-term in nature, but certainly not all of it.
When you talk about being defensive against some of the inflationary pressures or inflationary trends here, is there a sense here that should the Fed whenever actually finally come off the floor, that in and of itself could sort of blunt the impact of some of these inflationary pressures? Does that then make some of those hedges maybe a little bit too premature?
Oh, Romain, that's a fantastic point. I get it a lot from clients. The question is, why would I do this now when we still have the spigots on full force from the federal government and the central bank? And my answer is that they're cheap now. They won't be cheap later. So I think the most prudent strategy is to go accumulating some of these inflation hedges while they're still cheap, while we don't have inflation, under the expectation that the velocity of money, which is effectively, Romain, which is effectively the reason we haven't seen inflation take off for the past decade, despite M1, M2 growing in double digits, not repeating itself. So velocity of money is, of course, the change of money in hands, and that's increasing. So we expect that to take off, and I expect that in 2021, we're not going to see as rosy, 2022, we're not going to see as rosy a picture as we do this year, which is so favorably benefited by base effects, right? Last year was horrific. Earnings are up 30%. They're probably going to be up more than that in 2Q. These are things that we are all expecting. So I would say start hedging now. positioning for a more difficult environment over the next 12 to 18 months, Romaine.
Yeah, it'll be interesting. I'm curious, Kathryn, about your thoughts on just correlations on a lot of these assets. There's been some concern here that we are kind of in an everything goes up market, at least for a lot of the primary asset classes here, and that if we do sort of hit a bump in the road, everything's going to come crashing down. Are you worried about those correlations?
That's why we like alternatives, commodities, even cryptos, gold, venture capital, private equity. That's why we're actively recommending some of those lesser correlated asset classes, Romaine, even emerging markets, into the portfolio as kind of an inherent hedge into long U.S. equity positions. We don't want to prematurely leave U.S. equities because there is likely to be additional upside until we get, as you mentioned, it's kind of that shoe to drop. My expectation is that what's going to cause the next correction is inflation, and the Fed can no longer ignore it. And my suspicion is that it comes in a more aggressive fashion sooner rather than later.
Yeah.
Can you imagine, Romaine, if we have the Fed even talk about tapering? I mean, they're not even talking about it. They're not contemplating it. Or can you imagine if we talk about the $6 trillion that have been injected in terms of fiscal spending, not fully injected, but promised over the past 12 months, if we get any even talk of retracing any of that deficit financed stimulus spending, that's not going anywhere. All of that money is going to be, in my view, converted into just massive social spending. So this is a combination, I think, that's potent for inflation, but it's also potent for ongoing appreciation of risk assets. So let's be judicious about it. Let's have a barbell strategy, and let's position for inflation, which is something that's historically so difficult to predict with precision.
Yeah, very smart stuff, Kathryn. And it'll be interesting to see once we get that jobs report. If it comes in over 1 million, like some people are projecting, you wonder if the Fed really can stay put the way it keeps signaling to the markets. We have to leave it there, Kathryn. We'll catch up with you soon. Kathryn Rooney Vera, head of global macro and chief investment strategist over at BLOOMBERG Capital Markets.